everyone, I am Marjorie Casas. I am the last reporter of Chapter 12 and I'm going to discuss the drawback of the currency market. First, when depositors use a regulated banking system, they know that the probability of a banking failure would cause them to lose their deposit is very low. Second, borrowing funds internationally can expose a company to foreign exchange risk.
It means bank failure that would cause depositor to lose their money is greater, although in absolute terms are still low.
This is the global bond market. Grew rapidly during the 1980s and 1990s and has continued to do so. It means the new century bonds are important means of financing for many companies.
These regulatory barriers made it difficult for a corporation to attract significant equity capital from foreign investors. These bonds are usually issued by large multinational organizations in offering the bond to many investors.
Eurobonds are normally underwritten by international syndicate of banks and placed in the country other than one of whose currency the bond is dominated. Bonds are sold outside of the borrower's country and are denominated of the currency of the country in which they are issued. Of the Eurobond market. An absence of regulatory interference, less strict disclosure requirements than in most domestic bond market, a favorable tax status. Regulatory interference. National government often impose control on domestic and foreign issues of bond denominations in the local currency and hold within their national boundaries.
Example, if a firm wishes to issue dollar-denominated bonds within the United States, it must first comply with SEC disclosure requirements.
Favorable tax status. This did not encourage foreigners to hold bond issues by U.S. corporations.
Tax advantage refers to the economic bonus which applies to certain accounts or investments that are by statute tax-reduced, tax-deferred, or tax-free. Government establishes a tax advantage to encourage private individuals to contribute money when it contribute to be in public interest.
The global equity market. Historically, substantial regulatory barriers separated national equity markets from each other. Not only was it often difficult to take capital out of the country and invest it elsewhere, but corporations also frequently lacked the ability to their shares on stock markets outside their home nation.
A global equity fund has a latitude to buy shares of companies from any country including United States. A typical global equity fund will keep a certain portion of its assets and its stocks balance and invest in international stocks. Share capital, common stock, preferred stock, capital surplus, retained earnings, treasury stock, stock options, reserve.
Foreign exchange risk and the cost of capital. While a firm can borrow funds at a lower cost in the global capital market than in the domestic capital market, foreign exchange risk complicates this picture under a floating exchange rate regime.
The two primary methods of hedging are through forward contract or a currency option. Forward exchange contract. By entering into this contract with third party, the business can protect itself from secret version and currency exchange. The foreign exchange can invest currency hedge funds. The best way to protect your foreign returns is to invest in mutual funds. Exchange trade funds that are hedged. These funds usually use sophisticated investments like futures and options.